Well, good morning and welcome to the Reserve Bank, and thank you very much for attending. With me at the table is John McDermott, who's the Assistant Governor and also the Chief Economist of the bank. And next to John is Dean Ford, who's the head of the forecasting team. The economy grew at a 3% annual rate in the first half of the year. We think the economy slowed to an annual rate of around 1 to 1.5% in the second half of the year. Inflation and the labour market has been weaker than expected. Our forecasts suggest annual growth accelerating to 2.5 to 3% over the next 2 years, and there are several factors that would support that. First is the global economy. It still remains soft, but we see it as less threatening than earlier. Second, repairs and construction in Canterbury are gathering pace. Third, funding costs for banks have declined by around 30 basis points since the beginning of the year. And fourth, mortgage rates are at the lowest level in 50 years. But there are also some important factors that are dampening growth in the economy, and these include the government's projected fiscal consolidation, the continued caution by households and businesses in their spending decisions, and the high New Zealand dollar remains a significant headwind. The outlook we see is for stronger growth in domestic demand, with inflation rising gradually towards the 2% target midpoint. Our focus in setting monetary policy will be to keep future average inflation near the 2% target midpoint, and we'll closely monitor indicators for further moderation of inflation, but we'll also monitor those indicators in terms of the reconstruction-driven pickup in investment, and we'll watch to see if there's a greater degree of inflation pressure than our forecasts assume. So thank you very much indeed. Happy to answer any questions.
So Wheeler, you note risks to the inflation forecast in both directions. Do you have any sense yet of which might prove the stronger?
It's a very good question, and it's one that we spend a long time thinking about, particularly because inflation in the traded goods sector is negative, largely as a result of weak inflation overseas, but also the strong exchange rate in New Zealand. And inflation in the non-tradable sector has also decelerated, but remains positive. So we're looking at that very carefully. But also, we're cognizant of the inflation pressures associated with house price increases, particularly in Auckland, where house prices have increased by 12% over the last year. But nationwide, it's a lot less than 12%. It's around 4 to 5%. So we're looking at that carefully. But we're also looking at the construction program in Canterbury and the pickup in residential and non-residential investment in Canterbury, but also elsewhere. In Canterbury, over the last year, inflation or construction cost prices have picked up by 10%. Now, they haven't come through to generalised inflation at this stage, but we're monitoring that closely, given that it's hit double-digit levels, albeit low double-digit levels. I'm sure there must be more questions. So.
Your TWI projection is quite a lot higher. Could you just take us through why you think that and how significant it is for the rebalancing and future growth prospects?
Let me ask John to make some initial comments, then I'll make some of my own.
Okay, sure. I mean, the TWI obviously is a relative price between New Zealand's performance and the rest of the world, and we've been watching for quite a long time the frustrations of global growth, and things are very slow, and the exchange rate has stayed where it is in this level for quite a long time. And so that's the reality which we're putting these projections together. I'll have to also stress that the exchange rate we put in the statement is a technical projection rather than a forecast, and we understand that things can change very rapidly as well.
I mean, the TWI is, the exchange rate is stronger than what we want, that we want to see. We would like to see the exchange rate lower if we could achieve it without threatening the inflation outlook and also financial stability. The exchange rate pressures, if you look back over a long sweep of history, there's a close relationship with the terms of trade. But what you've seen here, I mean, we've seen the terms of trade decline now for 5 quarters. Commodity prices are starting to pick up, and they've picked up over the last 5 months or so. But you see the exchange rate remaining very strong and doing considerable damage to the traded goods sector, particularly manufacturing and also import substitution tied in with manufacturing. What's driving a lot of it is the global liquidity injections that are coming from the major economies. And there seems to be a close relationship between the pickup in overseas share markets, if you like, world share indices, particularly in the US, and a pickup in turn in the exchange rate pressures faced by countries that have reasonably sound monetary policy, good growth prospects, and reasonable prospects in terms of commodity price outlooks.
You note the liquidity projections, injections, sorry. Are you looking at any ways to mitigate those? Has there been any thinking at the bank about that? In terms of the liquidity injections that are coming from overseas, those sorts of pressures, there's not a lot directly that we can do about that. The issue is, you know, what can we do to try and alleviate exchange rate pressures? You know, there are circumstances in which the central bank could intervene, but we've yet to find situations which meet all our traffic lights, if you like, at this point. There are other governments have looked at capital controls. We don't think that's appropriate for New Zealand. So, in essence, it's something that a lot of countries that, as I say, have better growth prospects and have rising commodity price outlooks and reasonably sound macro policy, they're facing this upward pressure on the exchange rates, and it is hurting their traded goods sectors in many of their economies.
You're still projecting the government to run deficits right through till 2015. Is it dreaming that it's going to get back into surplus in 2014-15?
Well, that's probably a question better addressed to the government, to the Minister of Finance, and perhaps to the Treasury. Our own forecast suggests that by 2014 or 15, that the government will have a deficit of the order of about 0.75% of GDP, which is roughly $1.5 billion. The difference between our forecasts and those of the Treasury mainly lie in terms of what we'd call the GDP deflator, given that by and large we have similar outlooks for GDP growth. So we see lower GDP price inflators, if you like, a lower GDP deflator than the Treasury, and that will affect tax revenue.
Given that mortgage interest rates are at a 50-year low, would you say these days it's better to buy than rent?
let me let me ask my chief economist that and see what he's doing.
Well, I prefer that you answer.
Well, no, I'll answer it in a minute, but I want to hear my chief economist's views. I mean, if you look at house price affordability here, house prices look to be expensive to me. I mean, I've lived in America for 15 years. What we saw in New Zealand from 2001 to 2007 was the most rapid house price appreciation in the OECD. Those house prices came moderated, but they didn't come back very, very substantially, if at all. And that's why I wanted to ask my chief economist whether they did come back at all. I wasn't here at the time. But if you look at house price affordability, say, relative to household disposable income, that ratio is around 4.5 times at present. It was 5 times in 2007, so it's come down, but it was around 3 times in the 1990s. So house prices, to me here, look expensive, and that's one issue that we pointed to in our financial stability report. We pointed to the potential systemic risks that could lie out there if house prices did start to come off significantly. Now, let me see if John has any thoughts.
Well, you've provided most of the details. The obvious part of the answer also is it also is going to be critical on personal circumstances. Right now, you point out mortgage rates are very low. That's true. That lowers housing affordability. But the issue is interest rates can always move sometime in the future. Inflation rates can always move sometime in the future. You wouldn't want to be in a position where you're highly leveraged and are vulnerable to a very rapid change in circumstances.
So first, then Brian.
Do you foresee the need to introduce some loan-to-value ratio to stop the banks from lowering that? I think it's around, a lot of banks are offering 5% deposits and things like that at the moment.
We've been doing a lot of work here in respect of macroprudential instruments. And by macroprudential instruments, I think of things like loan-to-value ratios, risk weighting on asset classes, counter-cyclical capital buffers, and core funding ratios, things like that. Now, we've been developing a memorandum of understanding between the Governor of the Bank and the Minister of Finance, and been discussing that with the Treasury and been making very good progress. And we would see macroprudential instruments as really very valuable, a valuable tool to have in terms of helping us with our mandate to deliver financial stability in the system and to reduce the vulnerability that could build up over time with credit price bubbles or other asset price bubbles or liquidity injections, for example, or rapid liquidity growth. Let me just give a little bit of background, and I'll come to your question in a moment. I mean, what we saw for example, in the US was very rapid house price increases during the period 2002 to 2007, when the global economy grew at its fastest rate in 40 years. And, there was a debate that would appear at Jackson Hole and around central banking circles about how much should central banks lean against asset bubbles. And the view taken by the chairman of the Federal Reserve at that time was in essence that monetary policy wouldn't be effective by and large in pricking asset bubbles, if you like. But monetary policy should stand ready to pick up the pieces, if you like, when those asset bubbles burst. And I think that thinking has proven to be incorrect in the sense that the judgment that you stand back from asset bubbles when you see them emerging is wrong-headed. Because what we've seen is central banks used to worry about the wealth effects from asset bubbles and how they would spill through the economy in terms of demand growth and inflation outlooks. But people forgot the immense damage that bursting of asset bubbles can do in terms of deflation and output losses and rising unemployment. So that's why we're very keen to develop these macroprudential instruments. We are talking to banks about asset prices, about their lending on housing. Some of them have been increasing their loan-to-value ratios, and we have been raising that at the chief executive level with banks. We also raise it in our regular meetings with the boards of the banks. For example, when we meet with the chairman of the banks and their boards, which we do regularly. Grant Spencer and I, Grant the Deputy Governor, we're regularly meeting with banks and discussing with them loan-to-value ratios, their lending strategies, the nature of their book, the prudential risks that lie around that, etc. At the moment, in terms of macroprudential instruments, at the moment, given what we see out there in terms of house prices nationwide growing at around 5%, and we think that that might continue for a period but then ease off to flat in real terms. That's what our forecasts show. And given that credit growth is around 2 to 3% in the economy at present, albeit accelerating in recent months, at present we don't see that we would need to use macroprudential instruments. But that could change at any time in the future if we felt that asset price bubbles or liquidity bubbles were starting to build up and potentially pose a destabilising threat to the economy.
But you also mentioned the risks in this to your monetary policy target, and there does seem to be a warning shot there. You paint a picture, or the forecasts do, almost of a contest between aggressive competition among banks cutting mortgage rates, raising LVRs, running up against continuing caution on the part of households. But the threat seems to be that if you see the former sort of becoming the stronger in that sort of arm wrestle, you will raise the OCR. Is that a fair gloss of what the document's saying?
The outlook we have is for the OCR to remain stable for quite some period. I mean, our projections don't show an increase in the OCR until next year. Next year being 2014. We think that the house price inflation threat that we see out there will start to moderate. We know that Auckland is driven by significant housing shortages. We know that there's been significant underinvestment in housing in Auckland in recent years. We see the population pressures. We know where mortgage interest rates are. And we've been talking to banks, as I say, about their loan-to-value ratios and their lending to first home mortgage buyers, etc., where they've been quite aggressive in some of the loan-to-value ratios that they've been using. But we also see residential construction starting to pick up. We're seeing more housing stock come onto the market, and we think that there are limits in terms of house affordability that will constrain the house price increases. But if we're wrong, and it started to feed through into inflation pressures and affect our ability to achieve our objectives under the Policy Targets Agreement, then we would, in those circumstances, have to adjust and rethink our interest rate policy.
How do you think you'll know when you have an asset bubble that you have to lean against?
I think it's really once you start to see prices really pick up and accelerate. I mean, looking back, for example, in the period 2001 to 2007, when we had the most rapid increase in housing prices in the OECD, during that period of time, had we had macroprudential instruments available, then we should have applied them.
Do you think there's a risk now with house prices rising at more than 10% in Auckland and people offering 100% home loans again, which I understand they are from mortgage brokers I've spoken to, that we are at that point where it looks like an asset bubble is building?
I think it's too early to say. I mean, we look at Auckland, and I just mentioned the sorts of factors that were that we see driving the Auckland housing market. If the supply response doesn't come through and those house prices accelerate, and we're seeing that pattern spreading through the country, and bear in mind that house price inflation for the country as a whole is running at around 4 to 5%. If we started to see that accelerate significantly, then that would cause us concern, yes.
What sort of urgency are you progressing this memorandum of understanding with the government at? Because it seems that to me that the bank's been talking about this for quite some time. And is there a risk that if you don't have these tools ready to go, that if you do get caught out with a takeoff in house prices, that you risk crunching the economy by having to, your only response is to hike the official cash rate?
We've, as I said, we've been having very positive conversations with the Treasury, and we've completed, the two agencies, the Central Bank and the Treasury, have agreed, if you like, on a draft memorandum that should apply between the Central Bank, the Governor of the Central Bank, and the Minister of Finance. And we had an initial discussion yesterday with the Minister of Finance on that.
So when will the bank be in a position to actually, the Minister of Finance to be able to sign off on this? I mean, can you give any more details on just how far away this is?
I can't really. I think the Minister is keen to study it more and also perhaps discuss it with some of his colleagues. So you'd best ask him on that.
You talk about the reconstruction of Christchurch at $5 billion happening up until 2015, and then we're going to see the other $25 billion playing out over the next decade. Do you see a peak on that? Are we going to see a flat kind of play through on the other $25 billion? Yeah. How do you think the reconstruction will play out?
Well, I'll ask my colleague to comment on that in a minute. What we've built into what we understand to be the reconstruction program, if you like. We talk closely with Sierra, we talk to the insurance underwriters, and we talk to the EQC and trying to get numbers. The overall program we see is of the order of $30 billion. 30, Dean, is it? Yes, $30 billion. With insurance payouts a bit higher than that, perhaps of the order of $35 billion or thereabouts. What we've built into our forecasts, is $8 billion of reconstruction spending in the period to March 2015. But as for the sort of profile of the decade or how that might play out, let me see if Dean or John have got any comments.
Sure. The answer to your questions in figure 5.2, and it's important to actually look at that profile and just recognise the different classes. So there's just taking the three broad classes. Infrastructure is obviously it's relatively urgent to get waterworks and sewer and what have you sorted out. So that happens reasonably quickly, and the work peaks in 2014. Residential construction is the lion's share of the rebuild. It takes a long time, but it's something that should be peaking maybe around 2015. The commercial stuff that's less urgent, and that will take over the next decade, and it's a long time before we see that being completed.
Mr. Wheeler, given your earlier comments that you thought the housing market was expensive, are you renting or do you intend to buy?
I probably should be, shouldn't I? No, we bought a house a few days after we arrived in the country.
Well, that gets back to the question. I said that houses were expensive.
So,
You said that houses were very expensive in New Zealand compared to the United States, for example. Is it better to rent at the moment?
well, I don't know what the arithmetic looks like on that. I mean, I can't give you a definitive answer. All I can say is that house prices in relation to disposable income still look to be high, and certainly much higher than in the 1990s. And house prices relative to rent on a national basis still looks to be fairly high to me.
So it's better to rent.
Well, I've said what I've said, that it looks fairly high to me.
How much risk do you see of a substantial correction in housing, like perhaps greater than 10%?
Let me ask John first as the chief economist, then I'll make some comments.
So as I understand your question, you're asking is there a substantial risk of house prices actually falling in a sense?
Well, a risk of a substantial correction of more than 10%. How much risk do you see of that happening?
At this stage, the risk we think would be very small. But in our projections, nominal house prices are projected to actually still increase for the next few years. Beyond that horizon, we think real house prices, so house prices adjusted for inflation, will be roughly constant. And given the economy is recovering, even if it's slowly, it's still recovering. So incomes and jobs will increase and making security around actually buying a house a little bit easier. So the answer is small.
I think probably the answer is small, but it would be worrying if there was a sharp fall off in house prices. What you've seen in countries like Canada after the global financial crisis, house prices just continued to rise, and you've seen some measures by the central bank to try and arrest that. You've seen very rapid house price increases in places like Hong Kong and Singapore as well. Where you've seen rapid declines in house prices in countries that have very distressed banking systems like the US, for example, when it was at the peak of the global financial crisis, or in Ireland, you've seen very dramatic declines in house prices. Now in the US, it's mainly in Florida and California and Colorado, Arizona and Michigan. And you've seen some very dramatic declines in house prices there. If we were to see a rapid decline in house prices here, it would be potentially quite destabilising, one, for the economy if it was rapid and large, and two, also for the banking system.
Do you think that regional loan-to-value ratio targets could be useful to target a housing market where one large part is moving differently to the rest?
I think once you get into regional measures, it starts getting very tricky. But I'll ask Grant, who's the head of our financial stability, and also, as you know, our deputy governor, to make some comments on that. I mean, there are other instruments that would form the macroprudential toolkit, if you like. I mean, one would be risk weightings on asset classes, for example. That's something that the central bank could look at if the circumstances merited it. there's counter-cyclical capital buffers, and there's also the core funding ratio requirements and that. But let me ask Grant whether he has any thoughts on regional LV ratios.
I think that would just be getting too complicated, quite frankly, and very difficult to enforce. If you allowed high LVR lending to Taranaki, low LVR only to Auckland, I think you'd find some money going to Auckland via Taranaki. So yeah, too complicated.
Two questions. One is that you've got two very large downward pressures on inflation here, the currency and a tight fiscal policy. To what extent are they effectively doing your job for you as far as fighting inflation, and what are the risks around them going the other way and reversing some of the current settings?
Well, it's certainly true that one consequence of the high exchange rate has been to put significant downward pressure on inflation and traded goods inflation in particular. And as I said, that's negative at the moment. To the extent that the high exchange rate is diminishing inflation pressures, then that basically means that the bank needs to be less aggressive at any particular point in time in terms of its OCR policy. But let me see if John has any additional thoughts.
Well, only to point out that that's balancing various upward and downward forces is always the challenge of monetary policy, and also the prospect that they change quickly on you is also a constant challenge.
In box D in the monetary policy statement, there is a discussion about what could be done if house price inflation became excessive. Would you prefer to use macroprudential tools first, or would you have to immediately act with a change in monetary policy, the official cash rate?
I think if we felt that this was an asset price bubble that was gathering momentum and threatening to do damage in terms of the stability of the financial system, then the sorts of tools that we would look at would be macroprudential tools in the first instance.
You mentioned here that global outlook looks a bit less threatening, but I just wondered how big of a risk you see the discussions around the US fiscal cliff and what the impact would be on New Zealand. And also we seem to be seeing a bit of a mixed picture out of Australia. And given that it's the leading trading partner, how big of a risk is that for New Zealand as well?
I mean, the US is always upper mind in your consciousness, if you like, when you're doing economic forecasting. I mean, it's 21% of world output. I mean, what's happened in the US is very interesting. I mean, you've seen a lot of the deleveraging take place in the business sector and in the banking sector as well, where the banks are considerably ahead of Europe and the UK. But you haven't seen that. You've seen the government dissaving very rapidly and running large fiscal positions. Most forecasters assume, and I think it's a reasonable assumption given past history, that there'll be a muddling through of some sort in respect of the fiscal cliff. I mean, the cliff is indeed a cliff in that sense that it's roughly 4 to 4.5% of GDP in terms of automatic spending reductions and tax increases, and that would do significant damage to the US economy. And you've already seen corporate profits that are at historic post-war highs. Despite those post-war highs, you're seeing investment basically being deferred in the US because of the fiscal cliff problem. So most forecasters, I think, assume that it'll be some form of muddling through. Remains to be determined. I mean, who knows? It might be of the order of 1 to 2% of GDP or thereabouts, but if they get through this, then they've got the debt ceiling discussion just a month or two later. So I think that's the base expectation that's built into most forecasters and also into the market. If you did get a bipartisan agreement that could bind future Congresses in some way or had some credibility in respect of future Congresses, then I think that would provide potentially significant stimulus to the US economy, just removing that uncertainty. In Australia, one of the challenges I think the Australians face is they've got their spending programs or their investment programs on resource development that start to come off about 2014, 2015. You've seen some projects already deferred, some have been cancelled, and that's an issue for them. You're also seeing that with their very high exchange rate pressures, that outside of Western Australia and Queensland, you're seeing some quite slow growth in those other states, or quite depressed conditions in some respects in those other states. But let me see if John wants to.
The other factor that matters is, of course, China. And China matters both to New Zealand directly because it's our number 2 export destination, but also to Australia directly. And we're seeing some very good indicators in terms of industrial production, manufacturing indicators, housing market, and even retail sales have all turned somewhat positive in China in recent times.
Right.
When did the Reserve Bank start talking to the trading banks about higher loan-to-value ratios, and what was the response?
Well, in essence, we talk. I'll get Grant to offer some thoughts in a minute, but we're talking to the banks all the time in terms of our prudential responsibilities. I mean, this is just an ongoing thing. When we're doing formal reviews, or whether Grant is meeting the chief executives or I'm meeting the chairman of the boards, so we're always discussing with them, the nature of their book, what their lending strategies are, any concerns we have. That's just core business for the institutions. But when we've been going round recently, we've certainly been talking with them about their housing portfolio and their lending strategies and how they're seeing things. But let me ask Grant if he wants to add something.
I think that's a fair comment. At this point, it's monitoring. It's part of our ongoing prudential discussion. Part of that is monitoring the risk in the banks around their lending, and the LVR profile of that lending has an important bearing on the risk. So it's part of the prudential discussion. It has not been a matter of us giving directives or attempting to jawbone changes in their behaviour at this point in time. It's an ongoing monitoring of the risk situation.
You're not too impressed with the Household Labour Force survey recent result from the look of things in here. To what extent is I guess accurate data on factors like this becoming an issue of you? You're not the only economist who's queried the HLFS. Are you in any discussions with Stats on way to improve things?
We talk to Stats a lot. And Jeff Bascan in particular and his colleagues. We talk to them about GDP revisions, and we talk to them about the HLFS series. I mean, it's not the only labour force indicator out there, as you know. I mean, there's the quarterly employment survey data that gives a clear picture gives a picture as well. And there's the quarterly survey of business opinion in terms of hiring intentions. We look also at that. And we also look at the Ministry of Social Development's data on unemployment benefits. So we look at all these things and trying to work out what we think is truly happening in the labour market. But we are, to answer your question, yes, we are talking to Stats on a regular basis in terms of data improvement and what can be done. But let me ask Dean or John if they want to add anything.
Sure. The only thing I'd say is that we always face volatile data, and sure, the HLFS is quite noisy and has caused some confusion. But in New Zealand, we're quite lucky to have a wide range of data on the labour market, and we've always upweighted or downweighted whatever the HLFS has said based on whatever the other indicators are saying.
You've said you're talking to the banks regularly about prudential issues and LVRs included, but does that mean you're concerned about the increase in LVR, high LVR lending to 95%, and I understand in the last couple of weeks 100% home loans?
Yeah, I'll ask one of my colleagues in terms of the 100%. We've certainly seen LV lending in excess of 80% and also in excess of 90%, targeted often at first home buyers. But it's something that in our communications is first in terms of the regular prudential reviews, but when we're meeting the senior management and also their boards, which we do regularly, we are asking them about their lending strategy in respect of LV lending. We're asking them how they see the market develop, what the potential demand is out there. So there's a regular conversation in that as we're monitoring the situation. But Grant, did you want to add anything?
I think while high LVR lending has been increasing, in other words, 80% plus LVR lending has been increasing, the amount actually over 90 is quite limited. So there'll be the odd situation where, there's a 95 or 100%, and in those situations, typically there'll be the borrower will have a lot of assets and very high good debt servicing capacity. But in terms of the bulk of the market, most of this growth in higher LVR lending is in the 80 to 90% category. And if it was getting up above 90 in any real volume, then that would be a point of concern. No.
Just back to the labour force survey, I was just wondering how overstated you think that the unemployment rate has been by that survey, and just what your impressions are of the labour market.
Well, let me ask John or Dean if they want to comment on that.
Yeah, I mean that's a fair question, and we've been thinking about that quite a lot recently. And it's fair to say, look, the HLS certainly deteriorated sort of 3 quarters in a row, so you can't completely dismiss it as general weakness, in the labour market, and it probably is corroborating a sort of week's momentum in economic activity in the second half of this year. So that we already understand. But taking at face value, if you took the number and said it was the absolute truth, it would point to something much worse in the economy. This economy would be going backwards, not forwards, as we think it is at the moment. And so that's why it really is important to look at the other indicators. Remember, this is a survey of households. The QES is a survey of businesses. They tell actually quite different things at the moment. If you had a better survey, a full census survey, so you surveyed everybody in the labour market, and actually Stats New Zealand do that. They have something called the lead measure, which would be very useful, and it takes all the tax data and puts it together. The unfortunate problem with it, it's too slow. It arrives a year late. But if you take the historical data and put them together, you say it's somewhere in between. The real truth is somewhere in between QES and HLFS, and you have to take it on that basis.
So how overstated would that make the unemployment rate? I mean, obviously, assuming it's not going to be at that 13-year high, 7.3%. I mean, have you got some kind of idea about how lower it is?
So we expect some of the aberration that we think is in the data to reverse the next quarter. I wouldn't be surprised if you get a number, in the short term, you can still expect a number around about the 7%. But over the forecast horizon, in the next 2 or 3 years, that we expect that number to move down to the rate 5 or below 5%.
I was wondering if you could just talk briefly about tourism. Looks like the high dollar may be affecting volumes of tourism, and I wondered how much of a threat that poses to the overall economy.
Well, let me ask my colleagues on that, but certainly the tourist numbers have dropped off, no question about that. But Grant?
So an important thing to remember is that no matter who you are, coming to New Zealand is a luxury good because it costs you at least 2x leave. People aren't spending on luxuries at the moment around the world, so that's having a big negative impact on tourism. In addition, the high New Zealand dollar is absolutely having an impact.
And the overall threat that poses?
Do you know, John, in terms of
it's about a third
weights?
of exports at this point. So you can get a scale of the measure of the impact.
In box B in the monetary policy statement about the new policy targets agreement, there's a comment here that the agreement reflects the view that monetary policy's best contribution to long-run economic growth comes through ensuring low and stable inflation.
Mm-hmm.
Don't you think the global financial crisis and the change in views on this around the world should be reflected by the policy targets agreement?
I think if you look carefully at what central banks are doing in the OECD region, for example, basically they're inflation targeting, and that's been the case for a long, long time. And New Zealand was I think the first country that started inflation targeting many, many years ago. I think what has developed out of the global financial crisis is that just simply having low inflation does not necessarily guarantee financial stability. That you can see the potential with low inflation and high rates of liquidity and strong global growth and pick-up in world trade and all of that, and changes in risk-taking in an economy, you can see that you can have low inflation but still very large asset bubbles emerge that can do tremendous damage to your economy, especially when they deflate. That can cause significant impacts in terms of financial distress, unemployment, business failure, and the like. And so I think central banks around the world have been searching for additional tools to be able to try and address that and counter the risks of the potential financial instability that could emerge even with low inflation. And that's why we believe that the toolkit with the macroprudential instruments that we're discussing with Treasury and now the Minister of Finance is very important. Well, thanks very much indeed. Thank you for coming along.